India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. We are starting a fresh week and there is so much ground to cover, especially because the global scene is completely looking very different from where we were looking at it on Friday and, of course, over the last couple of weeks. I'm Prashant. With me, my colleagues Nigel and Surbhi with us today as well. Guys, hi, good morning.
Hi, guys. Good morning. Some exhilarating sporting action over the weekend, right? With the heart beating for Mr. Sen and also the hockey team. But I think we have an equally exhilarating ride lined up now in the global markets arena as well.
Well, the thing that made me most happy on Sunday was the Indian hockey team, the way we fought back. And, so that was really something special. But in terms of market action, we've got plenty to track, right? Weak economic data coming to the United States. You have geopolitical tensions as well. And the Japanese market getting smacked. Oh, I love those visuals. That's the most positive for me over the weekend. Let's pull in Shrijesh, I think, What a keeper. I mean, we were down to 10 men and he, almost made it equal for us with, he stepped up and saved so many goals. But good work by the boys. And I hope a gold is coming home yet again in hockey. It's been a long, long while. And I'm just looking forward to that.
Let's see. Maybe it can happen this time. Fingers crossed.
Absolutely. Fingers crossed. And, we'll sort of talk more about this. But let's get this straight down to markets because that's essentially looking a little troubled as well. I'll start with where we left off on Friday, essentially. You had, the data which I think nobody really was paying too much attention to. And that is the one data which mattered. I'm talking about the US jobs number, which came through on Friday. And it triggered, a sea of multi-sigma moves. I think about 70-75% of the moves that we saw across asset classes were one standard deviation above. And you had many which were, 3, 4, 5 standard deviations above the normal. So, really large moves. The data itself, so US added 114, this is the non-farm payrolls number. It added 114,000 jobs against expectations of 175,000. And the unemployment rate has also risen to 4.3% from 4.1%. Now, markets, of course, got a jolt. It's a seriously low number as compared to expectations. And, essentially, from looking at a soft landing, markets basically moved to recession kind of odds. That maybe we are in a situation where a recession is already, beginning or is. But it was a lot of extrapolation which happened. Shock value, equities, everything sold off. By the way, there is, of course, one indicator which suggests that the US actually may already be very close to or already in recession. We'll talk more about that as we go along. But equity sold off hard. S&P was down 2%. Nasdaq was down 2.5%. The Russell was sold off as well, about 3.5%. So these are deep cuts coming through. Wix at one point jumped to almost 28. And then, of course, it ended at about 23.5, 25% higher on the CBOE Wix. The 2-year, the front end of the yield curve lost 26 basis points. We are at 3.87. The 2, the 5, the 10, the 30 all lost over 20 basis points each. The reaction of the 2-year absolutely correct and in line because markets are taking up the odds of Fed rate cuts very, very sharply higher. So dollar index also was down 1% to about 103. Essentially, the bet is that, if you got a global slowdown, the US was a bit of an outlier. The US also is looking like it's slowing down dramatically. And if that is the case, you essentially are to expect a lower dollar. Fed cut pricing soared after the jobs data. So markets are now expecting 50 basis points worth of cuts in September and November and a 25 basis point cut in December, January and March. So for the rest of this year, you're basically looking at 125 basis points of rate cuts. So, really rate cut expectations skyrocketing. We've not heard Fed speakers reacting to the jobs data. So if, as and when they do, I think that becomes important. You also have a few other data points through the course of the week. Oil was down 3%, broadly a big risk-off kind of a session is what we had on Friday. And this morning, most Asian markets are lower as well. Let's come back to levels here, right? Because one thing we know, you look at the reaction of the market here on the day of the budget, the capital gains tax hike, you look at the election mini shocker, you look at other data points, the market here has been Teflon coated, right? I mean, you've thrown anything and everything in this market and it does react once in a while for an hour, 2 hours, half a day at best, and then it moves right back up. I just want to say one more thing. The Nifty only corrected last week. It ended down last week. But if you look at the other indices, most other indices, including the Bank Nifty, they all started correcting about 3 or 4 weeks back. And actually last week, if anything, the other indices started to come back up. So there is a bit of a lead lag going on. So I think it would be wrong to just look at the Nifty and the way, it is set up. The rest of the indices, especially the Nifty Bank and a few other sectoral indices, are looking like they may have already actually corrected a little bit over the last few weeks, and they actually are starting to come up. So I just wanted to sort of put that caution on board. Don't extrapolate the big gash across global stream to the market here. Levels then, supports for the Nifty come in at the 20-day moving average, which is 24,588. Below that, you're basically looking at supports coming in at about the 24,200 level. The Nifty spent lots of time around these, around the 24,200 level, so should act as a bit of a support. For the Bank Nifty, watch Friday's low, which is 51,087 first, and then the swing low, which is 50,438. On the way up, I think we can talk about the way up when the way up happens, but for the Nifty Bank, that is the 20-day moving average, which should act as a resistance, which stands at about 51,953. The GIFT Nifty will come up on your screen, and I think we will start around some of these supports that I was talking about. So 350 points lower right at the word go this morning. Surabhi.
This buy on dips is really going to be tested for this market right now. The resilience of the Indian investor, all the money flow that's coming in. Will the dip be bought again? We've absolutely sort of, been cruising past any kind of negativity for the market. So this is another test. It's a global test. And let's see what happens. Prashant, I guess you mentioned the new rule. That's the SAM rule, which is flashing red in terms of recession.
It's not quite there. It's point. It's I think about 80% there, 85% there, but another 15 basis points, and you're officially looking at. It's a so-called SAM rule, right? It's a Fed economist who came up with that rule. And we'll. It's one of the indicators which people are watching.
Okay, absolutely. So, well, you've got I look at it as quadruple blows for the market. One is this non-farm payrolls data, which was exceedingly negative. The second is a tech sell-off, really accentuating in the US and getting more negative feedback from companies. Look at Intel, down 25%. Because of the earnings miss, because of the layoffs that they're announcing. Amazon, again, missed estimates. The Amazon stock was down 9% during trading hours and continued to sell off in post-market trading as well. So you've got US tech, just sheer numbers, corporate numbers not adding up. The third blow is coming in from Asia. Look at the sell-off in Asian markets. Markets are down anywhere between 3% to 6%, with the Japanese markets, some of those indices cratering 7% in the morning. Now, what's happening here? The whole yen carry trade has come into question. The yen surged all the way to 160 plus, or rather, dramatically fell to 160 around the starting of July. In the last 1 month, it has surged 8 to 9%. And today, if you look at the yen-dollar equation, that rate is now hovering around 145. So the pace of the rise of the yen has really caught a lot of market participants by surprise. And it's leading people to question whether the whole concept of the yen carry trade, because it's a currency where interest rates are so low, so you borrow cheap, then you go invest in high-yielding assets, whether a lot of that is getting undone in the last couple of days as well, and whether, it's the starting, beginning, middle, or end. We'll ask our guests as we go along. The fourth blow comes in from the Middle East. You don't know what's happening over there. A lot of hectic geopolitical action over the weekend as well to keep Iran and Israel from really, doing a face-off with each other. But that remains a watch point. Oil fell, of course, on Friday because of the recession worries. But let's see. Hopefully, the Middle East will not add more to the issues over here. Just quickly back home, some of the results of the weekend were also a mixed bag. Divi's was a miss. Britannia margins slightly lower than expectations. The top line seemed fine. On SBI, the numbers are okay. There's a small margin compression of 12 basis points. But let's see, depending on the market's mood, whether you'll start looking at the negatives, which is the rise in slippages, which is the rise in provisioning. It all depends on the market's mood and positioning, and we'll see how that plays out. Last but not the least, fund flows for the record. As usual, DII is net buyers of almost 3,000 crores worth of stock. FI is on the sell side, about 3,300 crores sold off. So we have a lot happening this morning.
Well, the Japanese investors must be wondering, right? They waited for more than 30 years to see fresh all-time highs.
Yeah.
And in a matter of, 10 days or so, they've given up close to around 15-18%.
Absolutely.
Wait for 30 long years, and then, in fact, you get that sort of a result. But let's tell you about the Indian markets. And, domestic flows are going to be top of mind. And keeping in mind the kind of domestic flows we have seen, I expect the Indian markets to continue to outperform. And there are a couple of positives as well that are coming through. One of them is in Friday's trading session, if you look at it, towards the last hour of trade, we did end at the low point of the day. So in that case, the traders and the investors here, they were prepared for a weak handover. Preparation because the last tick was at the day's low. The other positive was, in Friday, yes, we were lower, but we outperformed some of our Asian peers. So those are the two positives I'll take away from Friday's close. What about the FIs? Well, the net long contracts have come down. And I like to see some shorts getting into the system. So I'll prefer that, in fact, this number comes down further and we get some shorts in the system. The other factor is the client positioning. Well, they cut their short positions. At the first sign of a bit of a dip, those shorts did cover out. So that's a positive as well, because remember, the clients have been getting it right. So if we get this number back in the positive, then that will give you a sense of how they are viewing this market in the futures and options space. Moving to the options data then, the PCR, that's come down to around 0.91 odd. To give you a reference point, normally we see it bottom out when it goes to around 0.7. So there is some distance to go on that side. But there were two strikes that were fairly active. 24,800 call, well, that was active in trade, 40 lakh shares out there. While the 24,700 put, 10 lakh shares getting added, 166 rupees. So for those writers, they'll be looking at that 24,500 mark as a very, very crucial number. And if by the end of today, we can end somewhere around the 20 DMA or maybe above that, the bulls will say it's a job well done. Because if you break that support level of around the 24,500, then you're heading to the previous resistance level, which is at around that 50 DMA, 23,800 odd mark. The banking space is going to be very important. And HDFC Bank, even in a weak market, that ended with a gain of around 1.2%. The last week, it was up more than 3%. And that's telling you that it wants to defend this 20 DMA. It's managed to close above that mark. So there has to be some firefighting that's done. HDFC Bank is the one I'm looking at. And in that context, since SBI's numbers, if you could look at the positives as well as the negatives, but there wasn't anything very, very negative. And the stock had corrected close to 6% getting into these numbers, 5 to 6% approximately from higher levels. So on the Nifty Bank, well, we'll be tracking a few levels. The 50 DMA is important out there on the Nifty Bank. That comes up for you on the screen. And the recent support zone of around that 50,500, which is a 5% correction from the top. So we start off in the red. I think at some point of time, if the global cues stabilize a little bit, we could see a bit of a fight back.
Oh, absolutely. And, to add one more positive beyond all the cues that we've discussed, states that have been at the margin in terms of just the economic growth of this country, they got investment over the weekend. The Tatas are setting up a new semiconductor facility in Assam. Ambuja announced a new grinding unit in Bihar. So beyond all the cues, I see that as a big, big macro positive as well. So let's not lose sight of the positives too. Moving on then to the equity call of the morning. Chris Wood of Jefferies says the moment that greed and fear has been waiting for, what seems like an eternity, finally has arrived on Friday. That is, he says, unambiguous evidence of a weakening in the U.S. labor market at a time when inflation is still above the Federal Reserve's 2% target. He adds the reaction of the money market shows that investors share greed and fear's long-standing view that the Fed, in the event of such an outcome, will prioritize the labor market over inflation. He says money markets are now discounting 116 basis points of easing by the end of this year, whereas before the payrolls data, it was only 86 basis points. He says an intra-meeting cut, the first time since March 2020, now looks likely.
All right, well, that's Christopher Wood of Jefferies with his thoughts. Let's get you some money market views. This is B. Prasanna coming in on the rupee says, dollar weakening after the weak jobs data has made rate cut pricing more aggressive alongside reducing interest rate differential. Risk-off sentiment triggered by escalation of conflict in West Asia accentuated the carry trade unwinding. The rupee, however, underperformed the dollar as RBI and oil companies were reportedly buying dollars. Equity-related outflows are near-term headwinds for the rupee, and he sees the USD-INR pair trade between 83.65 to 83.95 to the dollar this week.
On bonds, Prasanna says recent data releases in the U.S., particularly labor-related, turn out to be much worse than expected, resulting in market pricing in over 100 basis points of cuts by the U.S. Fed in the current year itself, as FOMC also hinted for commencing rate cuts from September onwards. He says global yields rallied sharply, fearing recession in the US. He expects the MPC to sound dovish, even if it does not change its stance given the favorable domestic factors and turning global factors. He expects the bond market to trade with a positive bias and the 10-year benchmark bond yield to range between 6.8 to 6.95%.